I'm got it. Just hit the record button. Hey everybody, Cliff, are you on still, or I think Cliff?
Yep, I'm here.
Okay, cool. You want to kick us off?
Yeah, sure. I welcome everyone. Obviously, I don't know if you guys have known Charlie or sat through his renovation trainings already. A lot of good information here. Charlie Napalatano, he's our 203K renovation specialist guy from NORCOM. He's amazing. Charlie, go ahead. All good things, Charlie.
Thank you, Cliff. I can say the same about you, my friend, having known you a while now, right? So welcome, everybody. Nice to be here with you this beautiful Friday afternoon, as it is. So like Cliff said, I oversee the renovation and construction division at NORCOM Mortgage. As you know, I put the All Points logo in the top there, and for some reason it didn't put the full thing in. And which is a great way to start this. You know, we're partners, right, Steve? We're partners. We're a joint venture. Century 21, All Points, and NORCOM Mortgage. We're the lender behind the scenes. For anyone that doesn't know that, and as a direct lender, private, direct, local lender, we're in Connecticut 32 years. We're in Avon, where our headquarters is. You guys all probably know most of this, so I'm going to kind of brief. So we're a purchase lender, right? We do it all. We do a lot of business of all kinds, but we've always been heavily weighted on the purchase side. So as partners with our realtor partners, you guys know how valuable that is. Direct lenders make all their own decisions, underwriting, funding, everything. And we do that all in-house directly, including when we start to talk about my world, which is the renovation mortgage thing. The in-house funding is never more important, because that just means we handle this transaction from A through Z, application through renovation. That's not a Z, but you know what I mean. All the way through to the end. The same people that started are the same people that are finishing. That goes miles with our clients, needless to say. We're a mom and pop that does a ton of business. We're servicing almost $2.5 billion right now, of all kinds. And as a direct lender, I always say we're one of only a couple of hundred in the nation that are direct with Fannie, Freddie, and Ginnie, which is FHA government. So it gives us a lot of power. Renovation-wise, we're ranked up there. We're top 25 nationally in renovation business. So we do a considerable amount of it. Myself, before I go further, quick background for those that don't know me. I'm part of the Connecticut real estate scene for the last 25 years almost. Half of them, I've been a renovation mortgage specialist in Connecticut. I've been the guy, one of them, that you talk to when you need a renovation mortgage, when you as a realtor find out there's a problem with the house. That's usually how I was brought into it over the last bunch of years. A lot changed. See, there's the logo, how it's supposed to look, Steve. Look, see that? I got it right. It came late. So, okay. We're going to talk about my favorite subject, one of my favorite subjects, but renovation loans. What's a renovation loan? Over the years doing this, I had to explain it a lot earlier, what I was here to talk about. Most of you guys by now know what we're here to talk about. Hopefully you've heard of a rehab loan, I'm sure. That's where I used to be brought in all the time. Hey, this foreclosure is beat up and the water is 4 feet high in the basement. We need a rehab loan. Right? You may or may never have heard of a home style loan. You will if you haven't, because it's Fannie Mae's renovation mortgage. I mean, that's huge. It's a conventional rental. I know you've heard of that. This is what started it all. The 203K, FHA's renovation mortgage, right? This is what you've heard about over the years. As realtors, you've heard to run the other way when someone says this word. Stay away, right? That's the history of these loans. It's greatly changed over the years. And I was there to see it when it was a difficult transaction where it got the reputation that it had for so long. Choice Reno was Freddie Mac's version, VA Rehab. You do a VA loan for a veteran and include renovation. Most people don't know that. Everybody doesn't know that USDA, the USDA mortgage can include renovation. So I'll show you that a little bit later. I'll show you a map how most of our state is eligible for USDA lending, 100% financing for your buyers, and include renovation. So, all right, let me run through this list and give you guys the basics right out of the gate. Renovation mortgage. It's a normal mortgage. Cliff, right? You could tell the people you've done these. You know, after a couple of times, you realize this is just a regular mortgage with the addition of a contractor and an estimate to include whatever they want to do. Right? It's the financing for the purchase of a house and the cost for the improvement or the repair or the upgrade, all in one. One mortgage, one application, one 30-year fixed rate, one payment, right? Borrowers getting a normal mortgage with an amazing feature. They have normal interest rates, these mortgages. I already mentioned that every product out there, whether it's government or conventional or USDA, has a renovation mortgage. The rates are relative. A normal rate for a renovation mortgage is maybe half a point higher than the going lowest rate. It's negligible. It's part of the transaction. We'll talk a little more about rates in a minute. These mortgages are for all buyers, everyone that you have, your normal buyers and your abnormal buyers. We have plenty of those. What I mean by those, it doesn't have to fit the perfect cookie cutter. It's every buyer that you have out there. If they can get a mortgage, more than likely we can talk to them about including whatever they want, renovation. It's for all properties, same as above, the normal and the abnormal. So that means it's for a rundown rehab house that we've heard of all these years. And it's also for a perfect house that you could turn the key and walk into. But maybe it doesn't have something that they wish it had. I don't know. Maybe it's a deck on the back of the house. Maybe it's a new stone patio. Maybe it's a fence or a finished basement. Maybe it's anything that they don't have $10 or $20 or $50,000 to dump into their new home. They can include it in their purchase and finance it. There's a renovation loan for every buyer because of all the products. This is about adding value. It's about providing solutions. I didn't say it at the very beginning. The title of this presentation over the last, couple of years is Renovation Mortgage and Growing Your Business in a Challenging Market, right? It's a challenging market, wouldn't you say? Let's talk just a little about the market. Sorry. It's Halloween time almost, right? At least everybody thinks of this a couple months in advance. The market, right? The scary market. Inventory is at historic low levels, people, right? In case you didn't know. In case you've been sleeping for the last, 15 months. Rates are skyrocketing, right? Look at the skyrocketing rates. Okay, guess what? We talk about this a lot as a lender. It's leveling off. And really, guys, what's the real impact of 6%? This chart in front of you shows the last 40 years or more of mortgage rates. People have adjusted. Those people who were unfortunately knocked out of the market at 3%, the people are replacing them today because we're in a normal market, in a normal rate market, really, like we have been for years. So renovation mortgage, we're going to talk about providing solutions, expanding options, expanding the inventory. That's been my catchphrase for a while. If we can help expand the options of our home buyer, we can actually expand the inventory, have more to show people. If we can show them that they don't have to only look at the perfect dream that they had in their brain, we can turn it into that. There's less competition, there's less overbidding, there's more possibilities if we're considering options, thinking outside the box a little bit, right? Embracing change. Everybody today, we know it. People are going into the places they haven't been before, whether it's realtors or loan originators, even home buyers. We have to pivot to get what we want. Of course, building relationships. That was the last thing. So, lastly about the market, guys, I don't know if July home sales have dropped 20% year over year from last year to this year, right? I'm not going to beat a dead horse, aside for Jason showing up. Current listings, right? We're down from a year ago. This is why we're talking about these products the way we're talking about them today. I used to stand here and just talk about that everything was old. The houses were old. The houses are old, right? Now we're going to use that to our advantage. And we're going to, like I said, expand, options. All right. So 64%. What is that number? 64%. I wonder if anybody knows. That is, oh, sorry, my slide. Hang on. 64% is the number of listings that fell off over the course of the year because of some kind of challenge, right? We know we're looking in the right towns, we're looking in the neighborhood, we're looking, we're narrowing every day, we're narrowing the options, the available inventory. So we're talking about not just for rehab, we're talking about not just for broken. We're talking about not just 203K. Not everybody's an FHA buyer. We've always known that. So we have a lot more options to talk about. It's not your father's renovation mortgage. Like I said in the beginning, a lot has changed. There are experts, lenders like us who make this a specialty and make it as simple as any other transaction for our buyers. Wasn't created to make you guys hate us mortgage guys. It was created to help offer solutions. Today, that's all we talk about. So what's the problem? We know low inventory, high demand. This slide is 5 years old, at least. Not more, it could be more poignant than it is right now. We can expand their search, maybe include homes that need specific repairs. They could easily include in their mortgage. We know that the seller has to make no repairs on any item. We know there's less competition. Our buyers are able to get what they want. And as a listing agent, it's definitely a way to help win listings. When a home we know needs updating, we know it needs something, and most of them do, we could be talking to these sellers and explaining that their home's going to be marketed toward the people who are ready, willing, and able to buy their house exactly the way it stands as is, because they want to make the changes and improvements themselves. The aged housing stock, been my song for a long time. Any house can be modernized. Any house can be updated. It could be a perfect house. It could be a beat up house. It could be the kitchen, bathroom, right? The floors, the basement, the roof, the deck, you name it. Buyers can save their cash. Today it's not an easy time for anybody. We all know it. People aren't flooded with extra cash to throw at updates. So if they even have it, they can save it. We're going to show them more houses. We're going to help them get what they want. So quick definition. I mentioned this at the very beginning, the financing to purchase a house and include the upgrades as one lender, keeping the process easy for them, holding their hand through the process, and making it all about just benefit. Renovations may be required or optional. I've said that a bunch of times. That's been the number one thing in all my years doing this that is most misunderstood by agents. That it can be optional stuff, that it doesn't have to have anything repaired in the renovation. It's a typical mortgage with the addition of a contractor and his bid. Here's a big one. The renovation, the available funds for the renovation are actually based on, and the whole transaction is based on the after completed value of the property. I'll say that a bunch of different times through the next half an hour. But what it really means is that our appraisal that our home buyer is getting prior to closing, that we're using to get them ready to close, their appraisal is based on the finished product of whatever they're including in that renovation. The appraiser goes to the house with the estimate from the contractor that we supplied to the appraiser. He's going to value it, like I said, as if that work's already done. So if someone's adding square footage, adding space, changing a kitchen or a bathroom, that's going to affect the value for the better. Little PS there at the end. Homeowners can also refinance with a renovation mortgage, even if they have very little equity. So keep that in the back of your mind. Cliff and the others, and Joanne and David, and all of our originators that you guys know that come to them. They know how this works. We're not using the same old cash out rules, 80% cash out to give people money, if they were looking to refinance. Today, with a renovation mortgage, they could use all of their equity as it's a rate and term refinance. It's not a cash out transaction. So if yourself or someone that you know, maybe they weren't able to move up, maybe they weren't able to sell, maybe it's not the right time, but they still need to expand and add space or add anything, they're going to want to talk to us about that. So I mentioned, that everything is old. I've been mentioning this. When you see these slides, you're going to know. Half of the housing stock was built in my favorite decade. Maybe some of yours too. I don't know. But half of our housing stock was built in the good old 80s when the crew was in charge. Right, Steve? That wasn't the cool crew. That was the bad crew, though. That's when they went glam. Anyway, we're talking about benefits, guys. I've said this. I'll say it again. We can expand the inventory if we expand the options, right? We can show the older houses that need whatever. The kitchen, the bath, the basement, anything. We could look at houses. We could target houses. I'm working with somebody right now. Target a house that clearly needs a roof. And there's no loan that's going to finance this house, conventional or government today. These people are making an offer today because they're the only offer. House has been on, get ready. It's been on the market a long time, guys. 9 days. And it's still there. But all kidding aside, this is the first real offer they're getting because this is the first buyer that went in that really knew what they were doing and what they were looking for. They're financing a $10,000 roof into the purchase. Seller doesn't have to worry about it. Their loan payment, their mortgage payment goes up about $60 a month to include the roof. So instead of $1,400 a month for their total payment, it's $1,460. And they got a house with a brand new roof that's going on in 10 days after they close. We're going to be able to overcome your favorite, right? Everyone has their own version of this. Oh, I like it, but, but it's on a corner lot, man, and it doesn't have a fence. I've got 4 little kids or 4 little dogs or whatever. And I don't have $12,000 for this fence, for this 6-foot PVC fence, and it's only going to cover 50 feet at that price today. You know what I mean? Seller makes no repairs. Houses can be sold as is. This is a big one, especially today. With a renovation mortgage, we can help save a transaction that's subject to a problem, whether it's an inspection renegotiation issue or subject to an appraisal problem that pops up. Or better yet, subject to maybe the appraised value coming in low. Not something we've had to worry about for a long time, but it's starting to become a thing again, isn't it? Seeing appraisals come in lower because people are overbidding and people are overlisting, right? So we'll talk about that a little bit more, a little further down. I'll make tell you guys a little story about how we saved the transaction and 7 days later it's still closed because we turned it from an FHA mortgage into an FHA 203K mortgage. We'll talk about that in a minute. We can target those tired listings. There's not so many tired listings out there, I know. But you know what? If we look hard enough, they're out there. Some of you may still know of them, right? We like it, but the kitchen's from the 80s. It's from before Motley Crue went glam. Okay? I do this for myself, Steve. I entertain myself. We like this one, but it was built in the 90s. Oh, that's not so bad. The 90s? 1994. That's only what? 28 years ago? Oh, man. That roof's done, right? This little house in Marion, a little while back, built in the 60s. In the 60s, right? But look at it. It's clean. It's clean as a whistle. It sat for a while. This is a couple of years old. This is before the pandemic. It sat for a while. I'll get back to that house. So my favorite channel, TV channel, HGTV, right? It shows like Fixer Upper, spurring demand for these renovation loans. This article is from 2019, by the way. My favorite logo, other than my band logo. HGTV with my friends, Chip and Joanna. I feel like they're my friends at this point. I feel like I know them. I want to have dinner with them. The Property Bros, right? On and on and on and on, guys. This is like brrr. Today. This is a few years old, this slide. I'm transparent. Vanilla ice down there in the bottom. Yeah. Guys, you turn it on today. Turn on HGTV tomorrow morning, Saturday morning, prime time. It's still going to be reno, flip. But people are now beginning to figure it out a little bit. What's going on? They're not finding these houses and then they have pockets full of cash. They're finding out behind the scenes people are doing renovation mortgages, especially since a lot of these shows are coming out of California, right, and Canada, and they're a little bit ahead with that kind of stuff. So the housing shortage, again, these are articles from 2018 in front of you saying that, hey, man, tough buyer's market, housing shortage, use these loans. This is from 4 years ago. So from that article on the right, The lament of the first-time home buyer. I don't know about you guys. I have a lot of first-time home buyers in my career to this day, especially as a renovation guy. They don't have enough move-in ready houses. We know this. One solution, there you go. Broaden the search. Look at the stuff. The old adage, handyman special, fixer-upper, right? You name it. But we teach the people, by the way, 33%, that's the number of first-time home buyers in our market. And it's been that way. I mean, that's not from 5 years ago. I change that number all the time. It's probably a little higher right now. Maybe, I think it is, because the government stuff has been coming back. These are the millennials. Why do I talk about them? They're, come on, almost 40% of the home buying market. That's huge. That's from 2018. It's higher today. And more than anything, you know, the point here is, if we don't think people are, we know they are doing their homework. When my phone rings and I'm talking to someone who I've never spoken to before, and they're talking about things that I know they just researched online. Some of it's wrong and some of it's right? But everybody in the world is researching. These guys, the millennials, when they're shopping for a house, they're finding renovation. They're finding 203K. I'm seeing that such a high majority of our home buyers using these mortgages are younger people. It makes sense. If you can't find it, we're going to create it. This is that little house I was talking about before. Check out what these people were able to do here. Look at the difference in living, right? Now, I say up at the top, they had a budget of $230,000. Now, what do I mean by that? As a mortgage guy, talking to my realtor partners, right? We're pre-approving our home buyer based on what they want to buy. We're not pre-approving people today based on their maximum that they qualify for. I mean, we give them that number when they're looking for it, but the conversation really always needs to be, how much mortgage do you think you want to pay? How much is your payment? What do you pay today? What's your rent like? We get into a number. This family, their budget was $230,000. So it let us shop for houses that were $230,000, $210,000, $190,000, $174,900, right? And they knew that they had a budget to work with when they found this house. They knew they had a renovation budget to work with, because that 230 number that we pre-approved them for, it was all in one. It doesn't matter if it's 230 or 220 or 210, right? That's the number. This particular couple, you know what? They were able to qualify for 300 if they wanted to. Okay. They didn't want a payment though of 300,000. They wanted a 230. Point there though, if it turned out they wanted to spend a little more money, we would have just approved them and lent them a little more money. We knew they were pre-approved for a certain amount. So we like it, but we don't want to be stuck one night with the rain coming in the roof, you know? So you buy it with a new roof. What does that mean? We buy it as is, but you know what? We're going to have a bid from a roof guy. We're going to help get that done. It's not hard. We'll get a roof bid. It's going to go in with our underwrite. It's going to go to our appraisal, and the house is going to be purchased like it's got a new roof on it. In this house, that was a $10,000 roof, let's just say. These guys did an FHA 203K. They were putting down 3.5% down payment, right? So that $10,000 roof impacted them by $350 at the closing table. Literally, that's it. And about $60 a month. It was a little longer ago. It was probably more like $50 a month at that time. Rates were lower. You know, so you don't like the kitchen? Let's change it. Let's change it. You know, you don't like the back. What's wrong with this house? Nothing. What's the problem? Well, it didn't have what they were looking for. These guys were from Florida. They weren't buying a house without a Florida room, right? I don't think we really call them that here, but I call it a porch or whatever. You get the idea, right? Oh, you know, we like it before and after. You know, some people think it's funny to make fun of me. I won't call out any names, but this is a before and after. No, my friend Steve Grandizio, we were creating the graphic for this presentation and others, and Steve thought this would be a good before and after. That's our executive vice president, James Morin. Granted, he's a few years younger than me, but that is definitely a before and after. We make fun of him as much because, look at him. He's like a Ken doll. If he were here, I wouldn't say that, but all right. I just, like to have a little fun. our home buyers, like I'm beating a dead horse, right? Shop by location, turn the house that they find into the house that they were looking for. Less competition, you know. Aren't you tired? I used to say, aren't you tired of showing people 20 houses on Saturday? They're never going to be satisfied. There's no 20 houses to show now. So now I say, wouldn't you like to have a house to show your buyer on Saturday? You know, let's identify, let's talk to them with a couple of bullet points, which I'll leave you with at the end, what you need to know as a real estate agent. Just a couple of things you need to know how to think and say, so to speak. We know you can do required stuff, go as is, and we know that they can have optional stuff. They can still do a minimum down payment. They can still have 0% down. They can still take advantage of down payment assistance programs, like the one that's sweeping Connecticut right now, Time to Own. If you guys haven't heard of that, I'm sure you probably have. Cliff, have you guys been talking about that?
Yeah, a little bit.
All right. We'll leave that for now. Normal rates, right? You're getting normal rates. It's not like it's 3% versus 6%. That's everybody, right? Now it's 6%. They want to do renovation. Well, maybe it's 6.25. Maybe it's 6 3/8. Maybe they're a little credit challenged, and maybe they're a half a point higher. You know, like, but it's normal. It's normal. They're not going to use whatever money they have left to do what they're going to need to do. We're gonna dissuade them from pouring their money onto their credit card, because 10 grand on a credit card is a car payment. It's not $60 a month like with a renovation mortgage. Instant equity many times, because we're basing their mortgage on the after improved value. I can't tell you how many times in my career I've opened up an appraisal report and said to my buyer, I know you're buying the house for $250. Your appraisal just came in at $282. And they go, I'm only doing 20 grand worth of work. How's that possible? Because that's how the appraiser sees it now. You know, it's powerful. I think these comments about 50 a month and 350, that's an FHA thing. You know what? If a home buyer was using a conventional renovation loan, putting down as little as 3%, because we can tie it to Home Ready and Home Possible, right? So as little as $300 extra out of pocket. Maybe they're doing 5% down. Maybe they're doing 10% down because they want to do that, whatever. How do they work? Simple. House plus the renovation minus their down payment. If they're making one, maybe it's not even, maybe it's 100%. They're left with a renovation loan. So from most minor cosmetic, like all we want to do is replace the carpets. All right. All we want to do is put in new appliances. That's it. Great. All the way to a total teardown of a house. Most of my realtor friends and partners don't want to get involved in that, but you'd be shocked how many of them it's landed in their lap and they go, can we really do a regular residential 3.5% down mortgage and knock this house to the foundation and rebuild it? Maybe they're getting a sweetheart deal and it's just a home run, right? It's like construction. All work, anything they're going to do, no matter what it is going to happen after closing. Remember that, after closing, by a contractor that they're going to choose. As long as the guy is licensed and insured and he's not a nut, and the guy's got a reference or two, we're gonna use who they like. We're going to walk them through the process. All right, the process. Speaking of the process, so back to my friends Chip and Joanna, right? The shop backwards thing. I said this to you guys about that little house I talked about in Meriden, right? Pre-approval is based on the total acquisition. What do they want their mortgage to be? The total acquisition. In this case, it's $350, right? They're looking to be, that's what they're going to be approved. Now, once they do make an offer and they do get a contract on a house, that blue line, right? It's going to be based on the purchase price, $280. That's what they're buying. That's the contract. It's not about the renovation. That's our buyer. But they know, based on their comfort level, they've got a budget of $70,000 to do what they want with, based on their wants, okay? At offer acceptance, we start the process. We start moving, we get things going. We can't order the appraisal, however, until we have the contractor's bid. So when people ask me about a time frame and I say, we close these in 30 to 45 days all the time, it's because we have a good handle on it, and we are able to connect somebody with a contractor or they have a contractor. Okay. The only thing that could delay the process where we could say, you know, maybe try for a 60-day contract, much, much larger job, or difficulty connecting with the right contractor. That's really the only, you know, if factor, so to speak. based on the after completed value. We close on the purchase contract date. Very important note. We close on the contract date. We're very proud at Norcom. Every lender, it should be their number one priority. The words "just extend it" should never come out of our mouths. Just extend that should never. We want to close on our closing date, no matter what kind of mortgage it is, including a renovation mortgage. Now, if we get a contract and it's 26 days from now, we should know to say we need a little more time. It's a renovation mortgage, right? But when we're putting these together, 30 to 45 days is very attainable. Close on contract date. You, as a lender, are paid on the purchase price. You're paid on your contract, and you're paid like you would normally. You're not waiting for a renovation to happen. Loan funds on closing date. The only difference is when the seller disappears with their money, the renovation money goes into our escrow account. We hang on to it. We distribute it. However, whatever type of mortgage, not important for you to know all that right now. So the types, I've been saying this all along, so I'm not going to beat this dead horse, but you'll see on the left, government, USDA, FHA, CHFA, right? On the right side, conventional, Fannie and Freddie. There you go. It says limited and standard. It means that a lender who does these as a specialty does these in two versions, a full standard version and then a limited version. The limited version is a lot of home purchases, and it's a lot of cosmetic, and it's $30,000 or less, and it keeps it simple. They work almost identically, but most of these, it's $30,000 or less, and it's done as a limited. And what you need to know there is we eliminate a consultant, we eliminate an inspection consultant, we eliminate draws through the process. We give the contractor half his money at the table and the other half when he's done. So I talk about this because these are some of those misunderstood items that people have out there when it comes to these type of mortgages. Qualifying, we qualify these people exactly the same way. The products are the same. Norcom Mortgage doesn't have overlays. All Points Mortgage doesn't have overlays on top of what Fannie Mae or FHA would have. So if they're doing a mortgage, they qualify the same way. I mentioned all the down payment, and I say at the end, 20% down. So yeah, you might have a conventional buyer who wants to do old school, put down a whole bunch of money, but they like the idea that they could finance 80% of their improvements at the same time. Home run. We do it that way. They have no mortgage insurance, they put down 20%, whatever, and everything in between, right? These allow for the non-occupant co-borrower and the gift funds, the things that we as lenders use many times to put somebody in a house that they weren't getting into, and having the ability to do this with renovation as well is priceless. Seller credits up to 6% with FHA, up to 90% with conventional, to 6%, all the same rules, guys. We'll use rental income to qualify on a home that they're buying, whether it's occupied or not. We'll use the rental, the projected rental from the appraisal. 75% of that is going to go toward their income to qualify, right? So another one of those little things we like to talk about, a home buyer that was looking for a house in April when rates were in the threes that just they're not making double the money they were making when the rates doubled, right? You know what? Some of these people are open to the idea that, a two-family house isn't so bad. And boy, that extra rental from upstairs could be the gap that bridges the gap, I should say, between the change in the rate and that extra $200, $300 a month that they're going to have to pay. Now they qualify, so something to consider. Any house, any condition. Speaking of condition, guys, this is not an inclusive list. This is just Charlie's throwing everything at you he can think of, right? Plumbing and electrical and roofs and gutters and all that. Full systems, windows and siding, these old houses, right? Septic and well. If I could tell you how many renovations we've done because of a bad septic, right? I mean, the house is great. The septic's blown. What an opportunity. I could name off the top of my head names of customers who bought a house and they only replaced the septic system. And, home run. Flooring, connecting to public utility, right? The well, hey, this thing's got to connect. They got to connect, and it's not more than 3%. They've got to connect. They can either pay for it or they can't buy the house. Roll it into the renovation. We could do structural repair. We could do full additions, mold and lead paint, chipping, peeling paint. Not, you know, we're not going to get away with just going conventional a lot of times to avoid some of these issues. Sometimes it's going to get to the point where it's not getting financed without this kind of mortgage. Asbestos, bugs, whatever. And then the happy side of things, right? Adding the good stuff. Living space additions, decks and patios, fences and driveways. Finish the basement. Add living space right with basement. Add appliances. You know, $10,000 worth of appliances. Easily put in. Swimming pool repairs. Can do anything under the sun. You can install a pool, right? I hesitate when I talk to real estate agents because you know what? That's not happening on a purchase. That's going to happen on a refinance because we know that it's not going to bring enough value to make it work. But know that it's out there. The energy improvement stuff, big landscaping, trees, major landscaping, moving a driveway, you know, putting up a detached garage, moving a garage, you name it, you name it. This renovation comparison chart is just to give you guys an idea, to give you an idea, to show you, wow, there's a lot there, you know, is to dazzle you, right? They all work a little differently. They all work a little the same, but there's a lot there. And there's a lot, you know, to know. That's why you work with the experts that you guys work with. But I wanted you to see just how much, you know, wow, it's not like it used to be. We thought it was this one FHA loan, you know. I talked about limited and standard already. Quick note on the home style, the conventional renovation mortgage. Our lending limits are through the roof, right? So instead of 420, 800 for the FHA loan, we can go as high as the conforming lending limit. Loans without PMI and the ability to eliminate it in the future. When you do a conventional mortgage, even if you only put down 3% or 5%, I don't know if everybody knows it, but that home buyer who maybe they're afraid rates are going to 10%, God forbid, that home buyer can actually drop their PMI later by just getting a new appraisal with their lender to show that they now have the equity. The lender has to drop the PMI payment, not refinance, just drop it, right? I bet you didn't know this. There's an investor renovation mortgage available. It's only conventional and it's only single family. People forget, you know, like single family investor renovation mortgage. Follows the investor guidelines, 85 LTV max. Okay. You can do a second home with renovation with 90 LTV, 10% down, because that's a Fannie rule. Luxury items that maybe you can't do with an FHA renovation. There's very few, but like say someone wanted to do something kind of crazy, you know, a tennis court or a gazebo or a cabana around the pool, something that is not really part of the house. The conventional loans will even let them do that, like a big pool, right? There's no identity of interest. So in the rare case where someone says, well, the contractor's my father or my brother or my mom, you can't do that with FHA, but you can with conventional. So there's always going to be, so these are some of those, avoid some of the FHA stuff that we want to not worry about. Freddie Mac has their own version. And guys, you guys are real estate agents. You're not mortgage people. But as mortgage people, this stuff we look at that we can go higher with a 3 to 4 unit property. We can go to a higher loan to value. We can go to 80% instead of 75 with Freddie Mac. Sometimes we can get an approval for somebody that we can't get approved with Fannie Mae. So we'll go in that direction as a lender, but knowing that we can do the same renovation add-on to it. USDA, I talked about this a little bit before. So I don't know how much you know about USDA. I'm a reno guy. So before we were doing the USDA renovation, I didn't know much about it. I didn't know that it was 100% financing. I didn't know the rates were better than FHA rates. I didn't know that the PMI, the monthly PMI, was almost a third of an FHA. I didn't know that if the property just had in the right place, people could get a loan like this. So it's a lower upfront fee than FHA by substantially, almost half. And the monthly is almost a third. So we can qualify people that maybe can't qualify sometimes with an FHA loan even. So flexible underwriting. Now, check this out. This is the United States, right? Who cares? This is Connecticut. If it's white, it's in USDA territory. So, I mean, Cliff sitting in Wallingford, I'm standing in Southington. We're not in USDA territory. But look around. Look at all the white all through the state. So, something to think about. Come to us, learn more about it. This is a quick little note about VA. Our veterans, they deserve the best. No more true statement than that. 100% financing. They have no PMI, no mortgage insurance on theirs. They can go up to $50,000 in renovations added into their purchase of their house. So whatever it is they're looking to do. And they use all their VA entitlements and all, and we do it the same way. And we're a VA loan expert, so we know what we're doing with that. Now we're just going to bring in a contractor and do something to the place. And by the way, contractor has to be VA registered to do this. You know what? We get them VA registered in 48 hours. So someone came to me and said, we can't do it. Their contractor's not VA registered. I said, give them my phone number. We'll take care of it by next week. All right. This is another of those. We like it, but yeah, I mean, come on. It's from the 80s. Look at the kitchen. Good Lord. These guys, they had a small budget, They cleaned up the mess and they redid the kitchen, and they're going to go from there. Right. So property types, it's everything, guys, basically. It's everything. If we can do a residential mortgage, we can do it, including mixed use. You see that there. Mixed use being an FHA, a property you can do with an FHA mortgage. Commercial on the first floor and residential above it, a nail salon or a deli or a liquor store, whatever, you name it, above. That's owner occupied, and we could do a 203K on that. So, perfect house, almost perfect house, whatever, you name it, okay? House like this becomes perfect little beautiful house, right? This is another one from my neck of the woods. Problem with that one. See that, but talk about it before and after, right? Now it's the nicest little house on that street with all those houses, right? These are people who are not buy down. What do you call it? Shrinking down, and they're going to stay there forever. All kinds of changes, as you can see, but these are houses that had nothing wrong with them. This one's got plenty wrong with it, right? Perfect USDA. It looks like it's definitely USDA out in the country somewhere. So, outside stuff, what a transformation with $7,000. Total transformation. Not going outside, hanging out outside this weekend, right? Same with this one. Not going outside, not going inside with that, right? So that house is not being sold like that. That house has got a problem. It's not being sold. Well, there you go. That's how they bought it. They did that to it. Nice little fence. So your action plan, look at the houses that maybe are hanging around. Cost per square foot lower than surrounding. Connecticut, the average cost per square foot is $199 square foot right now. So look at the ones that are, with the lower cost per square foot. You'll see it in the listing. And take a look. Back on the market, the offers that fell through. We heard a statistic in June, I want to say it was, right? It was in June. 60,000 houses fell off in June nationally that were under contract. I think that was 15% of the under contract houses. And we figured it out. We're so smart. Condition, right? People stopped making deals without inspections. People are starting to put an end to that. So the stuff that fell through, go look for those. Look for those. Might be the right one. Maybe it says one of these fun little phrases that I'm so used to, fixer-upper, great potential, Obvious repair. My buyers that found a house with the roof, they did that looking on Zillow, looking at the pictures, right? So now I know these say Norcom. Guys, we brand all our stuff with our partner. You know that. All Points Mortgage. I'm sorry, these say Norcom on them. Of course, I didn't have time to change those. It's a USDA flyer. That's a basic, let's help expand the inventory. This is a trifold brochure that we have one for all the products. They bust open and you could be standing with your buyer. And when you said to them, what if we looked at this house? And they go, what do you mean? You could stand with somebody and open up trifold brochure, spend 5 minutes going through some of the process, frequently asked questions, just talk with them a little and you'd be amazed how easy it is and how much they'll understand it. Same with this. So just to, I'm repeating what you heard at the very beginning. Show the older houses that need anything, right? Overcome, I like it, but I don't like your avocado fixtures and appliances. Seller makes no repairs. Be the expert. It's a competitive advantage. There was a time when I would be teaching my CE classes, and like we'd have people, but they'd be honest and they'd say, yeah, I would tell people to stay away from this. That time's over. Now it's in our culture, it's in our pop culture, and it's a solution. And if you don't know about it, you need to. And you do now, right? Grow your business with All Points and their partner. Ask every home shopper, would you consider this house if you could just roll whatever? If you could just roll it into the mortgage, would you consider it? Are we standing in maybe the right house? Make it the house they're going to move into. And, why us? We got a lot of experience. It's not just me. The owner of our company, Phil DeFranzo, is the owner of the company today. I spoke to him before I got on this call. He still runs our business. And he's been doing renovation mortgages longer than I'm in the mortgage business, 20, 40 years. He's been doing them for 30 years. Our company gets it. I came to Norcom 4 years ago to take on this role here because of the way that Norcom handles this business. I was already a rental guy, through and through. We do it all. Our third-party relationships are one of the biggest reasons we're successful. The consultants and the inspection services and the contractors and the people that we know help us throughout the whole process. Our division that's devoted to it, our draw department, we facilitate it all ourselves, start to finish, all the way through. Right? So there you have it. What questions do you guys have? Anything that we can address specifically? I just realized that my other slide didn't pop up I talked about saving a transaction that comes in short. Remember that? Let me throw that past you before I jump to the questions. This is 1 minute. We had an FHA buyer was buying a house. The house was $230,000 was the purchase price. Guy's approved, ready to go. Appraisal comes in. This is in May. I want to say April or May. Appraisal comes in at $220,000. Purchase price was $230,000. What are our options? You probably know. Maybe you don't. Our options are they could bring another $10,000 in cash. They didn't have it. It's an FHA mortgage. Or the seller could drop the price $10,000. That's not happening in May of 2022, right? Or June or July, probably. Or August. They're not dropping that price. So we're short, right? So what do? The short version is we turned that 203B. That's an FHA mortgage, by the way, a 203B. We turned it into a 203K. They added $3,000 worth of some small improvement. I think they did some carpets or whatever. $3,000 they added, okay? But because they made it a 203K, their mortgage was now based on 230 plus 3. 233 is how they did their transaction, okay? But the appraisal became 242. How did that happen? How could that possibly happen? That 220 appraisal, when it's a 203K, is actually 110% of the after improved value. We get an extra 10% cushion of value on a 203K appraisal, no matter what, no matter how they've come up. And maybe the appraiser has the estimate and says, they're doing a bunch of stuff that should have been done already, and I don't think they should get value for that. Maybe that could happen. But in a regular mortgage, it comes in short. We turn it into a 203K. That 220 appraised value really is 110% of it without changing anything on the appraisal other than they added $3,000. So the appraiser didn't give them a penny in value added to the 220. They didn't add a thing to it. But by nature of underwriting a 203K, the 220 became 242, and suddenly my 230 or 233 was no longer an issue. And the transaction closed as is. Seller got $230 for the house. The buyer paid $230 for the house. They included some carpet. They wanted the house. That was the way they were going to get it. So, okay. That's it from me. What questions can I answer for you guys? Anybody have anything?
Hey, Charlie, it's Tom Tussing. I have a question.
Sure.
When does the buyer start paying the mortgage? When they close or when the work is done?
Depends.
Excellent question, Tom. They pay when they close. So like any other loan, let's say, they're closing at the end of August. Their first payment is October 1st. They're going to pay their mortgage just like they would when they close on any other mortgage, not after the work. Now, that said, because I'm glad you brought that up, sometimes we have buyers that are doing significant renovations, that are changing properties and adding to them. And sometimes they're doing work that's going to keep them from moving in immediately. Maybe they're not going to move in for 60 days. They have the ability to actually roll in those first mortgage payments into the renovation so that it just gets absorbed in the whole transaction, and they can skip 2 or 3 or 6 mortgage payments to get into the home.
Okay, that was my concern. If somebody's can't move in because of the work and they're already paying a rent or another mortgage, I mean, how would that affect the loan? I mean, if they're got to pay more, you're saying they can roll it into the cost.
Correct.
Got it.
Correct.
Right, thank you.
And another quick little underwriting point. Even if they're paying a rent somewhere, for example, they don't need to include. We don't include that payment in their qualifying, even if they're crossing over as they're going to a new property. But yeah, great question, Tom. They roll that in, and they don't have to feel that pain in the very beginning. But they only roll it in if they can't move in.
Charlie, I had a question from someone about whether investors are acceptable here.
Yeah. So only in the rare, in the single family only, and only with the conventional renovation products, because obviously FHA is owner occupied only. We all know you got to live in the house. So yes, single family investor follows the conventional guidelines. So up to 85 LTV. So they put down 15% on the entire purchase plus the rental. So yeah, it's not a flipper product. It's how Fannie handles their investor products. It's more of a, people that are renting and holding. They can always renovate it and sell it later, but it's not really a flipper. We don't, they don't close and then flip right away. But yeah, single family. Long-winded answer to a short question.
Charlie, we had a question in the chat. I think as you were going, you mentioned there's no overlays because we're a direct lender, et cetera. Cam's question was, so a buyer can have a 500 credit score and get an FHA mortgage with 10% down payment. I know, I think we may have a credit score overlay of 580 on that with 10% down with an approved eligible. Is that right?
Well, good point. It's not an overlay, but FHA does not, and same with conventional, obviously 620. 620 is the low number for a renovation mortgage. So FHA requires a 620 to do the renovation mortgage. So to your point, we can still do the FHA loans, like you said, with the lower scores, but not with these. 620 minimum, and 640 when they're doing a full standard. 620 is for a limited.
Okay.
Any others? Anything else?
Charlie, in years past, I've had loan officers work with particularly younger buyers to house hack and become a first-time home buyer and an investor in the first property. And they've actually used the 203K on a multi-unit. You just touch on that, because I think that's a pretty cool strategy too, because then also you're dealing with higher loan limits. Absolutely.
Multifamily purchase, again, all the years of, I want to be an investor. Hey, I'm an investor. What do I got to do? Well, you got to put down a whole bunch of money. Oh, forget it. I'm not an investor. Right? Now it's, would you consider living in the property? Well, yeah, I consider. All right, great. Up to 4 units, right? With FHA, up to 4 units. They live in the property. They're still putting down the minimum down payment, 3.5%. And those other 3 units, the gross rental from the other 3 units, 75% of that counts toward their income. Now they're qualifying, like you said, Steve, for a much bigger property, bigger mortgage. And as a strategy, I'll tell you firsthand, a couple of people popped in my mind immediately when you said it. Buying my first house, Charlie, it's a 2-family. I'm going to live there. I'm doing a 203K. They fix it up and make it beautiful. He wants to move on. He wants to do it again. And I say, well, we could do it as a conventional. He says, well, no, I need to do another 203K. This kid, we refinanced his two-family, this a few years ago, we refinanced him into a conventional, and now he's not going to have two FHA loans, so he can do another 203K. So he made his 2-unit an investor property, right, because he moved out of it, turned it into a conventional loan. He didn't have to. He could have left it FHA and moved on, but he would have to use conventional next time, right? This guy, two-family, bought it as a 203K, lived there, fixed it, refinanced it to a conventional, moved on, bought another property with a 203K, did the same thing, lived in that one, completely redid it. Okay. This time he moved on, left that one alone as an FHA loan, but he bought his single family forever house with a conventional mortgage by himself. And now he's got these two investment properties that he bought and renovated, and, you know, so
two investment properties with primary residence rates as well.
Correct. Exactly. With primary residence rates. Good point. He never did it originally as an investor. So, yeah, good point.
Anyone else? I know we're at 12:01. Anybody else have any questions? Jody did record this, so I'm sure she's going to put it out there for anybody to watch later. And I know there were a bunch of requests for Charlie's chart. So I know Joanne responded a couple times. So we'll make sure that the loan officers get you the Charlie's chart, just so you have it as a cheat sheet. Anybody else have any comments? Cliff, Charlie?
I do have a question.
Sure.
Limited versus the full. I would prefer my clients and would recommend to them to use the consultant, even though it may end up as a limited. Do you have something like for the steps that they would have to go through using a consultant, and would that consultant replace the inspector? You know, in some cases you're not going to necessarily want a home inspector to go through to tell you that an outlet is wired backwards. You want to use the consultant to make sure that we get everything done, so there's not going to be an issue with getting the FHA loan.
Yeah, good question. Most people, I'll be completely transparent. Like, most people are, even when it's a full with a consultant, they're still having a home inspection. There are a lot of people, though, depending on the nature of the work, that are using the consultant in place of the inspector because they're tearing out the entire kitchen and all the electrics, so they're not worried about the inspection. But depending on the nature of work, sometimes the consultant will go through, like you said, if it's a limited, he's not going to be going through like a home inspector, digging into everything. So obviously, I will never say you don't need the home inspector if you're using a consultant. But to your point, the consultant is a home inspector by trade, so you can avoid. To your point about using a consultant even when it's a limited, yeah, absolutely. You can always still use the services of a consultant. They definitely are the eyes of an FHA appraiser, most of it. They're able to see what the appraiser is going to call out. So sometimes we'll use a consultant or a consulting service to do a feasibility report, to actually, we can do it with your listings, you know, say, hey, you know what, this is what the experts think need to be done here, and this is what they think it's going to cost. And they'll actually produce a one-page sheet, a one-page write-up with basic estimate costs for these items to make the house what it needs to be. So it's a great tool. So definitely connect with us about that.
All right, thank you.
You're welcome. Anybody else?
Good questions.
Good stuff, Charlie. Thank you.
You're very welcome. You're very welcome.
Yeah, and I think the video would be a good thing to share out to the agents who couldn't join.
Yep. And I'm available, guys. This is one of the things I do here. So know that I'm available to do this again, and it doesn't have to be next year. We get another group together and we want to spend another hour together. Just say the word.
All right.
Awesome.
Thanks, everybody.
Thanks,
Thank
Charlie.
you.
Thank you, Charlie.